President Trump blinked twice last week, backing away from threats to dismiss Fed Chairman Powell and softening his stance on Chinese tariffs. Markets welcome these developments. Threats to Fed independence and aggressive trade wars are widely viewed as harmful to economic growth and corporate profits. We may now have moved past the worst of the tariff shock. The administration appears to be shifting towards more measured trade negotiations, suggesting we've hit peak shock and awe. The market narrative has evolved dramatically in recent months. After Trump's November victory, investors focused on potential benefits from tax cuts and deregulation. Early 2025 saw attention shift to downside risks from Doge cost-cutting and hastily announced tariffs. Now, as uncertainty subsides, we're transitioning from crisis to a new normal, one where America's economic advantages may still gradually erode, but at a more manageable pace. This stabilization creates opportunities. Meta particularly stands out. Earlier this week, Meta traded 13% below its fair value according to IQ's models. That triggered a bullish signal. While tariff shocks drove model value down 27% during early April's Liberation Day, it has since recovered 16%. Though the stock has risen, it still lags this improvement in broader macro conditions. Importantly, after a period where only company fundamentals mattered, macro factors have become increasingly relevant for Meta investors. For those maintaining conviction in US technology and anticipating a tactical market rebound, Meta offers an interesting opportunity to capitalize on the shift towards market normalization.